Today I'm going to show you several stocks all paying at least 5 to 10% dividend yield. All of these are common stocks and they're not BDCs or REITs, so they should have favorable tax efficiency. I also excluded limited partnerships due to their tax complexity. Now some of these are traded on the New York Stock Exchange or NASDAQ, but others are traded on over-the-counter markets and are ADRs. The highest rate ones are offered by European ADRs traded on the over-the-counter market. Now most of these stocks are not the most profitable companies. They're in industries that are very cyclical. Many of these have a high degree of debt and some have weakness at the moment, especially the car makers. One thing I noticed is that many of the large European companies have stopped listing stocks on the New York Stock Exchange and NASDAQ as ADRs and have moved on to the over-the-counter market, which has less regulation and requirements. Now, some have said this is due to the Sarbanes-Oxley Act. After the passage of the Sarbanes-Oxley Act in 2002, some companies delisted and became over-the-counter to save costs and avoid certain regulations. Now we see that the over-the-counter market is filled with multi-billion-dollar German conglomerates and not just penny stocks and failing companies as it's been in the past. Porsche, BMW, Volkswagen, Mercedes-Benz, all are listed on the over-the-counter market and are no longer listed on the New York Stock Exchange or NASDAQ and no longer have sponsored ADRs. These are all unsponsored ADRs. And it's not just the big European companies. BYD, a Chinese automobile company, also has their shares listed on the over-the-counter market available for US investors. Also, the Japanese company Nintendo has their shares listed on the over-the-counter markets. What are the cons of over-the-counter listed stocks? Well, first of all, they're not supported by some brokers. For example, the broker Tasty Trade does not support over-the-counter or penny stock trading. Also, Vanguard no longer supports a lot of over-the-counter stocks. On Vanguard's website, effective 2022, Vanguard no longer accepts purchases and transfers in most over-the-counter securities. They do allow some over-the-counter stocks to be purchased, but many are just not available at all. They have a strict criteria, so it has to have a 5-letter ticker symbol that ends in Y. That's the first one, but that doesn't meet the criteria. It has to have a market cap of over 300 million in US dollars. It has to belong in the top 3 tiers of the over-the-counter markets. Now on Schwab's website, if you actually scroll down to where it says US over-the-counter equities, there's a $6.95 fee to buy over-the-counter stocks. Now Fidelity does mention that there's a financial transaction tax of 0.30% for French securities, 0.10% for Italian securities, and 0.2% per Spanish securities. Also, they mentioned foreign ordinary share trading allows customers to trade shares in foreign corporations on the over-the-counter market using a 5-character symbol ending in F. Any of these trades that have a 5-digit symbol that ends in F, there will be a $50 fee for each transaction. So that would be $50 for a buy, $50 for a sell. So $100 even if you bought 1 share. So I'm going to try to avoid this and I'll show you here. And I'll show you what I mean. For example, we have the Volkswagen unsponsored 1/10 of a share ADR, $11.42. Now the dividend yield on this is 8.523%. If we look at the ticker here, it ends in Y, not F. So there actually won't be a $50 charge for this one. And when we preview this, you can see there's no commission. If we try another one, VLKAF, it's also 5 digits, but it ends in F. That means Fidelity is going to charge a $50 fee both on the buy and the sell for this. And we look at the stock, it also has roughly an 8.55% yield. Okay, now when we preview this one, it says it's going to be $60 because there's a $50 foreign settlement fee. If we pull up the Volkswagen ADR, we can get the quote in Vanguard, and it says here, exchange right here over the counter. If we hit buy, now in Vanguard, if we select the ADR that doesn't end in F, it's also showing up under commission as free. Now if we put in the ticker symbol VLKAF in Vanguard, and we scroll down, you can see it says US over the counter, and we select buy. Now look what it says. It says buy orders are currently not accepted for this security. Securities may be unavailable for purchase at Vanguard due to a number of variables, including regulatory restrictions, over-the-counter established, leveraged or inverse strategy, and so on. So this one's not available, so we don't actually have to worry about being charged a fee for this. They just don't make it available. Now, if we go back to the Fidelity fee schedule, it says a $50 fee will also be charged on each transaction in any foreign ordinary stock that is not depository trust company eligible. Okay, so my first thought was, can we search for what depository trust company eligible is? Maybe we can put a ticker symbol in and find out somewhere, but I haven't found anywhere where we can actually search for this. So I contacted this company here. It's a huge company, conglomerate. This is the company here, Depository Trust Company. Now I contacted them and I tried asking customer service, where can we search for what is DTC? What is DTC eligible? And the person I spoke with said, what is your company? I said, I'm an individual. Sorry, we don't deal with individuals. And then I called another number there and they said, maybe they'll be able to answer a question. Sorry, we don't deal with customers. Sorry, we don't deal with end users. You have to be a customer. So they didn't provide any sort of info. What DTC does is they provide some sort of electronic service where the securities are transferred electronically, where they don't have to physically send paper stock statements anymore. And basically, the New York Stock Exchange and NASDAQ, in order to get listed on those exchanges, they have to be DTC eligible. In order for a company to get on the New York Stock Exchange or the NASDAQ, as far as I understand, they have to automatically subscribe to an electronic service such as DTC. They have to automatically have this service enabled with DTC in order to get listed. However, on the over-the-counter market, there's no requirement that you have to be DTC enabled. So I figured every single OTC stock is going to be not DTC eligible, but that's not the case, because you saw that when I put in some OTC symbols, Fidelity is not charging a fee and Vanguard's not charging a fee. So some of these companies subscribe to the service and we just don't know. What are some other cons of OTC listed stocks? There's sometimes lack of liquidity and volume. If we look at the volume of Volkswagen, this isn't too bad, but you can see that from the little lines here, it's nowhere near what a New York Stock Exchange stock is going to have. If we look at Stelantis, for example, which is on the New York Stock Exchange, it has 7 million daily volume, so quite a bit more volume. Okay, another con is less disclosures and oversight. Now there's 3 levels of over-the-counter from what I've learned. There's the top tier, which has the highest reporting standards and the strictest oversight. And then there's the second one, and then there's the third one. Pink Sheets has no reporting requirements. Okay, now what about the lack of disclosure? For example, if I put in Porsche, the Porsche ticker symbol, or Porsche, however you say it, this is an unsponsored German ADR. We can find some info here that shows it has a 6.17% yield. We can see that it's over the counter. Now, if we scroll down, we can find some news, but we can't find anything about the fees. There's fees associated with the ADR. Now, any place that you look, Fidelity, Vanguard, any place that you look, you're not going to find the fees for that. You won't see the fees listed anywhere associated with the ADR. You won't see the taxes that are taken out. How do we find out what sort of fees we're going to be charged? If it's an ADR, it's a foreign company, so they're going to have different taxes. The great thing about the US is when you get a dividend payment, you don't have to pay any taxes on it. You pay taxes at the end of the year. So it's tax-free initially. So if you get a 10% dividend, you're getting the full dividend. Nothing's being taken out of that dividend. However, with a foreign company, the taxes are typically taken out first. Now here's the foreign tax withholding on dividends by country. So based on where the company is based, Australia would be 30%. Now I'm mostly going to look at the ones that have the most stocks. So basically Germany and Japan. If we look at all those German stocks that I just showed, it has a 26.4% hold on your money. Even if you don't have any sort of income in the US, you make less than $1,000 a year. You buy a German stock, for example, you're going to have 26.4% taken out of that dividend, out of every single dividend. And then you're going to have to deal with it at the end of the year when you do your taxes. Now, if we look at Japan, it's a little better. Now, I think it used to be 20%, but Japan is 10%. So Japan takes 10%. Okay, so what's the problem with that? I think the problem with this is I think a lot of the people that are investing in dividend stocks, they want to basically get that money every quarter. They basically want to get that dividend check every quarter and use that money to spend or do whatever and have use of the money. Otherwise, you just buy a regular stock that doesn't pay a dividend and you could just sell it whenever you want. The problem with that is Germany's holding 26 point whatever percent of that money for basically a whole year, and you're going to have to deal with it at the end of the year. So the question is, can I get that withholding tax lowered? Do I qualify for a lower WHT rate? Now, this is a website I found, the German company BASF. Do I qualify for a lower WHT rate? And it says the German tax authority has stopped taking ADR tax reclaims and has halted processing German ADR claims until further notice. So it doesn't even look like you could get it reduced. And it says here, I am a U.S. resident. What documentation do I need to apply for reduction of German WHT? So what if you want to get it lowered? I'm a U.S. resident. What documentation do I need to apply for a reduction of German WHT? It says U.S. investors need to provide certification of residency, Form 6166. And then you also have to pay an $85 fee. So an $85 fee just to get it reduced. And then if we look above it, do I qualify for a lower rate? It says the German tax authority has stopped accepting ADR tax reclaims. So until further notice. So it looks like they're not even going to lower it. So basically a good indication if a security is DTC eligible is when you go to place the order in Fidelity or Vanguard, it's going to show $0 or no commission. If it shows the $50 fee, that probably means that ticker is not DTC eligible. Otherwise, I haven't found anywhere where you can just enter the ticker in and find out. Okay, now what do I mean about lack of disclosures or fee transparency? For example, if I go into Vanguard's website or any website that has an ETF and I put in a ticker symbol, I just picked VGT, which is Vanguard Information Technology ETF. It shows the yield and it shows the expense ratio. So I know that I'm going to be charged a 0.10% expense ratio. It's going to be taken out of the price, but I'm going to pay it in one way or another. But I'm going to pay for the fee, and I can see it here. And there's also a prospectus that has the details about the strategy and so on. Now, if I go to the Securities and Exchange Commission's website and I search for Porsche, or Porsche, however you say it, and I select the Porsche ADR, according to the SEC, as investors, we're supposed to do our due diligence and look at the 6F report. Okay, well, here's a 6F report, or 6EF. If we actually look at this report, it shows that Citibank, I guess, is the underwriter or associated in some way. It shows this is for 1/10 of a share. It shows the number of shares that they offered and the fee that I guess the SEC charged. You won't see anything here about the fees that are charged to the investor. Now, if we go to another website that the SEC has called Edgar, now if we click on the prospectus here, you don't see anything about specific fees. This shows here certain fees and charges. It says it may charge for depositing or withdrawing shares. It doesn't say exactly what's going to be charged. It's just saying that they can charge you. So that's one example of what I mean by lack of transparency. But I did find a website. Though that was quite useful, this topforeignstocks.com. If we scroll down here, it says how to find an ADR you own has a fee. If so, what fee? And it has all the major underwriters here: BNY Mellon, Citi, JP Morgan. So let's pick one here. Okay, we'll put in Porsche, since we just looked at that. Well, I'm not seeing it here. Okay, well, I'm not seeing it there, so I'm just going to look at one of the other ones. Okay, I did find Porsche listed here on JP Morgan's website. We can see the dividend that was paid in June 2024. And when we click the PDF, we can see that the conversion rate from euros to dollars, we can see right here, okay, the withholding rate, 26.37%. So the original dividend was 27 cents. The tax withholding for Germany was 7 cents. And they're charging a roughly 3-cent dividend fee per share every time the dividend's paid. So the final dividend payment to the end U.S. investor per share is roughly 17 cents. So when you have a high yield with the German company, in the end, we're only getting about 65% of the dividend after all the withholdings and the fees. And we're never going to get back the one with the fee, but we may get back some of the tax one. Now, I have some shares in Toyota, which is a Japanese company and it trades on the New York Stock Exchange. I looked in the interface and I was charged 10% for taxes, and then I think it was 3 cents per share fee. And this is a sponsored ADR, so the company actually pays something for the ADR to keep it up. However, the point I'm trying to make is the fees and taxes can chip away at the dividend, and that's the whole point that most people invest in dividend stocks. For example, if we look at Mercedes-Benz, the ADR, if this were paying, it's paying 8.5% dividend yield, but let's say it's 9% for simplicity. So if we have if it's paying 9% after taking out the taxes and the fees, it's basically like, instead of getting 9%, it's like getting 6%. So that's the point I'm trying to make. So you have to lower these yields on the German ones because you're basically not going to have access to that dividend, a huge portion of it, and the taxes for a whole year. Okay, so what is the problem with the taxes on the ADR? Well, first of all, you don't have access to the money for a whole year. And if you're in a lower tax bracket already than the 26%, then you have to fill out a Form 1116. It's a foreign tax credit. This will offset a portion that was already taxed. So if the tax treaty withholding rate was 15%, the US taxpayer would not have to pay the 15% dividend tax rate. Okay, so one issue with ADRs when the tax treaty rate is lower than the foreign country's domestic withholding rate. And it mentioned Switzerland has a very high 35% rate. However, to qualify for the 15% tax treaty rate, investors must file paperwork with the Swiss government beforehand. There we go. That's the thing with Germany, the $85 fee, and they're not accepting it anymore. So if they don't do this, the government will withhold 35%, or Germany 26%, but the IRS will only give a credit for 15%. In this scenario, 20% is lost and can only be claimed if excess withholding tax paperwork is filed, which by itself is a cumbersome process. And from what I read somewhere else, I believe this is limited to $500 or so. And then you have to carry it forward to the next year. And so you're basically just, all that money is basically just being tossed down the road. So that's why I don't like German ADRs, because of their high tax rate. If we look at the qualified dividend tax rate, it's basically the same as the capital gains tax rate. So the highest one for long term. So if you've owned the stock for, I believe it's more than 60 days, it becomes a qualified dividend. And the maximum rate could only be 20%. So that's still less than what Germany is taking out. So how did these high dividend yield stocks perform over the last 5 years? As you can see from the chart, okay, so here's the chart here. This is Honda Motor Company here in orange. Okay, now here's price return without dividends. How did each of these perform? For context, this is the 5-year return. We have 5 years selected. The S&P 500 did about 91% without dividends included. So it would be probably around here. Now, if we look at each of these, even Honda Motor only did 38%. Chevron only did around 25%. Porsche, 28%. Altria, which has a really high dividend yield, only did 11.7%. Mercedes-Benz, 48%. Stellantis, 60%. That's one of the better performers. And if we look at Stellantis, if we look more recently, the stock went up as high as 180%, just the price return, and then it dropped significantly. We also have Kohls. Kohls has been struggling for a long time, minus 58%. Wendys, minus 18%. It hasn't went up very much at all. BMW, 38%. Then you have Volkswagen, minus 18%. Now, Volkswagen actually did pretty well until 2021, and then I think with all the Dieselgate stuff, it went down. Ford Motor, it did okay in 2022, and it's been down ever since. Philip Morris, 44%. Now let's switch to total return. If we look at the total return now, Philip Morris jumped up significantly to 90% because it has a high dividend yield. Volkswagen is still only at 1.4% return. So basically the same thing with the S&P 500 is about 107%. So the S&P 500, if we could put it on here, would be right around here, right above 107%. Kohls is still down 45%. One of the better performers is Stelantis. Stelantis has 101% return so almost as much as the S&P 500. Mercedes-Benz was one of the best performers, 139% return. Now even Altria, which has a very high dividend yield, I thought it would have done better, but even with all those dividends, it's still less than the S&P 500. Porsche has been losing money for a while. Porsche is at a loss, minus 11%. Chevron is still at about half of what the S&P 500 is at 55%. And Honda's at 60%. So even with the high dividend yield, even with these high dividend yields, most of these stocks have not done better than the S&P 500. I think Mercedes-Benz was the only one that did better. And if we actually factor that, actually this number is not correct anyways. All of these ADR ones are not correct. And even Stelantis, I believe there's 15% withholding. It's a Dutch company, so there's 15% tax on the dividend. But Mercedes-Benz, there's going to be, but all these European ones, it's over 26% that's removed from the dividend payments. So these returns, the total return is going to be much lower than this, especially if you don't get all the foreign tax credits at the end of the year. Now, if we scroll down, we can actually see the 10-year. They kind of hide it here, but the 10-year still not doing that well. Stellantis did 213% 10-year, but most of the other ones, not so good. Wendys had up to 183% return 10-year, but BMW only 28%, and that's total return. That's dividends included. So I think the point of this video is going with a high dividend yield is not always going to lead to superior returns or an adequate return. And I think we can see that here. There's only maybe one or two that would even be possibly better than the S&P 500, at least in the last 5 years, and that's Mercedes-Benz and Stellantis. So anyways, I hope you liked this video. Please like and subscribe. Please press that thumbs up button if you like this video and subscribe if you haven't already. Have a good one.